So today we have an exhilarating agenda as we delve into one of my favorite types of properties, a Class C 5-year hold. Let's see if it meets your financial goals. So buckle up and let's get ready to embark on a thrilling investment expedition. So we are going to start right here. This property is located in Atlanta, Georgia. And as many of ours are. And again, they've got it marketed as a Class B, but it really probably fits in a C. 100% occupied, which is really why I like this one, and in a wonderful metro area. So let's delve into some of our databases. This submarket, if this is the center of Atlanta, it's right here, right in our commuting center, getting closer to our higher end residential communities, but still well within a lot of development, business centers, as well as residential. It's right along an interstate corridor with high occupancy in apartment buildings. And what's super exciting about this one for Atlanta is it is right down the street from where the Braves Stadium is. So that area has for years been experiencing a rebirth, and that just continues to cascade outward. So this is just sitting in a really great location. So that area, we call it the Cumberland Galleria area. And I like to pull data just on, just to sort of get a high level on that area. So we've got some inventory, not a lot under construction. And you can see our vacancy rates are still pretty low over there, 3.6, considering there's a lot of older inventory. And that's represented in the data we see on this property. So popping into this, I've already said it's a Class C, and it is a strip mall. So we're in retail. You see what city center we're in. You can take a look at the tenant mix. This is definitely servicing sort of a middle to lower middle class population. Like I said, lots of apartments in that area, good commuting location. A number of the physical location itself sits on almost 2 acres, and the building is 14,000 square feet. Built in 98, says renovated in 2022, new roof and new parking lot resurfacing based on the broker information. And they are occupied at 100%. So we're just going to take those numbers at face value. I do have the leases in hand and have looked at them, but have not completed a complete package. They're asking for 3.935. That's really driven by this cap rate. Cap rate in this market right now, if we want to take a look, again, we're back in this submarket. We've got a big mall in that area, so that's going to skew some of our numbers. But luckily, with our tools, we can pull out strip center. And so I'm watching strip center, and you see over here, strip center's trading at about 6.56 just right now. Down from a 7. We do expect to see that head up into the next year, more in the 7.5, and at a peak up at an 8. So I think we need to keep that in mind as we're analyzing this. They're a little aggressive at that 6.2. But I think if we can get them in, closer to a 7.5 to 8, this would be a buy. So getting a little bit more into the property location, again, you can see a little bit of the pictures of the condition there. And then back to what I said regarding the product mix in that area, quite a lot of development, very low vacancy at 3.6. And good tenant mix. JR Crickets is a restaurant. We've got a barbershop in there. From what I understand, the laundry, coin service laundry, and the seafood place are both looking to continue operation and are willing to sign an additional lease. And if we take a look at the lease years here, the first one expires in 25, and they go all the way up towards the latter part of 27. So we've got a good good number of years on our 5-year trajectory that are already accounted for, with a pretty good expectation these businesses will stay in good situation. So this again is all the broker information. So let's pop over here, take a look at our spreadsheet. So I wanted to analyze this one on sort of like the lowest or the highest that I would consider to buy. So they're asking 3.93. Definitely pretty significant considering this market. So I went ahead and put a 3.25. Not sure if that would be accepted, but that's where I think our numbers work really nicely. Straight took their rental income straight off of where their contracts are now. The majority of them have a 3% escalation, and almost all of them are triple net. There was one with some water, but it was pretty much negligent. So we left those as triple net. Now the annual vacancy rates are a little aggressive. I pulled that from from some of the projections in the area. And so we've got some good leasing activity. Again, we've got this outlier in a mall, and we know this data isn't perfect, but this is a very big market center. So we've got a lot of numbers to work with, and there's a pretty typical space within that market center. And so you look at these vacancy rates right now, strip centers 1.5. We're seeing that exactly in this one. We don't see that going way, way up. So what I just took was the overall vacancy rate. But I think, again, that's a very reasonable number looking at this community. Then as far as expenses, be prudent just in case that we're going to hold this past 5 years to go ahead and start on reserves for CapEx. And pulling rates, we're sitting right now, today is August 2nd of 23. Depending on this borrower and their portfolio, we might be looking at somewhere around a 6.75 rate over probably a 10-year. I'd advise to go a little bit longer than you plan to hold, and a 75% loan to value. So plug all that in, and we get to a little bit on cash flow. So this investment is going to take close to $900,000 to make work with that 25% down. And we jump right into cash flow before taxes of $27,000, and then on a little bit of that change over here to cash flow after taxes, after we get some of that cost recovery. So we are showing that is right under a 4%. That's going to be okay for most investors. You're in line with CD rates, about a point below, but you're still throwing a little bit of cash off of your $900,000 investment. And then that continues for the majority. And again, we've got it contractually, assuming that those tenants stay, the majority of them are sort of transitioning over here in the 3rd to 4th year. And then upon sale, if we go back to my assumptions, of course, that's the biggest factor in this. I evaluated it 2 ways. Evaluated it on projections on what we see as projections for the cap rate going forward. So you can see we're seeing this cap rate expecting to sort of peak in about a year or two, and then sort of peter off. So doing a cap rate close to a little over 7.5, we got to these numbers as well. So if I evaluated it based on the cap rate and our future income, we're getting the sale price of around 3.8. And then we also evaluated it on pay over here at just as disposition price of appreciating at 3%, which is pretty standard, a little bit low for that area. But again, we want to sort of come in conservatively. So on that sale, our purchase price, our balance after the $900,000 injection of cash, we're carrying a note of just shy of 2.4. We're expecting that sale price to come in somewhere just shy of 3.8. Obviously, we have cost appreciation recapture. We also have some commissions built in there, and our recovery. And then we still end up with proceeds before taxes at 1.3, which could be 1031 into another property, especially if you're holding this as an individual. And not in a group, or again, if you just want to go ahead and take the tax burden hit, 1.2, and that's from your $900,000 investment. So let's see how this compares with other opportunities out there. Again, it's August 2nd, so current CD rates, we're sort of in this 4.5 range right now. So I always like to compare to a CD, just because it gives you a really nice comparison between the two risks. So before tax analysis, this has an NPV, assuming a CD would be your alternative investment of an additional $350,000, and then after tax 238. And again, if we go ahead and keep it with the majority of these funds not being taken as cash, but rolled over into yet another opportunity in 5 years, then we've got a pretty nice return here with the IRR at before tax 12, a little over 12, and after almost at 10. And the one thing I have not taken into account in here is cost segregation. I do like doing some cost segregation on this property in particular. We've got a lot of square footage. We have a lot of internal fixtures. There's quite a bit in here that could allow some of that bonus depreciation. So that's something that would be another added bonus. So we've baked a few of those things into there. We've projected the appreciation to be significantly lower than even some of the other models, especially the cap rate model. We have not taken into account any bonus depreciation, and we've also sort of elevated what we think our vacancies will be. So already we've got some contingencies built in there where I think that this property could perform even better than these numbers show. So here's our proof over here, which I always like to take a look at just to sort of give you a high level of what that cash flow is going to look like. If this is sort of a nice vanilla product, I like that it's already rented out. I like that some of the major capital work has been done. It's not a client mix that needs much TI, even if you do have a vacancy. So all in all, I think it's the type of product that somebody that's just looking to be in a strong market, 5-year hold, take as much depreciation as possible, and then relist it would find it very, very appealing. So thanks for looking at this analysis at Tradable Spaces. Our primary focus lies on educating investors and deal makers, guiding them towards the most suitable options aligned with them. And so our mission involves connecting buyers to lucrative properties while also assisting sellers and deal makers ensuring ownership of commercial real estate in a straightforward and legally compliant manner. So we streamline the process and we enable investors to concentrate on wealth growth rather than being burdened by compliance concerns and all the legal details. We help take care of all of that for you. So follow our blog to hear more. Until next time.